Section 1. Introduction to International Finance, written by Paul R. Krugman, International Economics Theory and Policy. International finance is, well, a fascinating and crucial aspect of the global economy. It deals with the financial interactions between businesses, governments, and individuals across different countries. In today's interconnected world, understanding international finance is more important than ever. This essay will introduce you to the key concepts within this field. It will explore topics such as exchange rates, foreign investment, and the intricacies of the global financial marketplace. Whether you are a student, a business professional, or simply someone who wants to be more financially savvy, this essay will provide you with a solid foundation in international finance. As our world becomes increasingly interconnected through trade, technology, and cultural exchange, the role of international finance continues to grow in significance. It touches upon many aspects of our daily lives, from the prices of imported goods to the performance of our investments in foreign markets. Section 2. Globalization and its financial impact. Globalization refers to the increasing interconnectedness of nations through trade, investment, and cultural exchange. It has had a profound impact on international finance, leading to a surge in cross-border transactions and financial flows. As companies expand their operations globally, they require access to foreign currencies to facilitate their transactions and investments. This has led to the development of sophisticated financial markets where currencies are traded and exchange rates are determined. The rise of multinational corporations and the integration of global supply chains have further amplified the importance of international finance. There's Section 3. Understanding foreign exchange rates. Foreign exchange rates are the prices at which one currency can be exchanged for another. They play a crucial role in international finance, as they determine the relative values of different currencies. For businesses engaged in international trade or investment, understanding exchange rates is essential. Fluctuations in exchange rates can have a significant impact on a company's profitability. For example, if a company imports goods priced in a foreign currency and that currency appreciates or becomes stronger, the company will need to pay more in its domestic currency for the same goods. Section 4. A brief history of exchange rates. The history of exchange rates is marked by a transition from fixed to floating systems. In the past, many countries operated under a fixed exchange rate system, where the value of their currency was pegged to a specific amount of gold or another stable currency, such as the US dollar. However, the fixed exchange rate system proved to be inflexible and prone to crises. In the early 1970s, the Bretton Woods system, which had established a fixed exchange rate regime after World War II, collapsed. This led to the widespread adoption of floating exchange rate systems, where the value of a currency is determined by market forces, such as supply and demand. Section 5. Navigating exchange rate quotes. Exchange rate quotes can be expressed in two ways, direct and indirect. A direct quote expresses the value of one unit of foreign currency in terms of the domestic currency. For example, if the direct quote for the euro in US dollars is 1.10, it means that 1 euro is equal to 1.10 US dollars. An indirect quote, on the other hand, expresses the value of one unit of domestic currency in terms of the foreign currency. Using the same example as above, the indirect quote for the US dollar in euros would be 0.91. Section 6. Buying and selling currencies, rates, and calculations. When you exchange one currency for another, you will encounter two different exchange rates, the buy rate and the sell rate. The buy rate, also known as the bid rate, is the rate at which a bank or currency exchange will buy a foreign currency from you. The sell rate, also known as the ask rate or offer rate, is the rate at which they will sell you the foreign currency. The difference between the buy rate and the sell rate is called the spread. This spread represents the profit margin for the bank or currency exchange. To calculate the amount of foreign currency you will receive when exchanging your domestic currency, you would divide the amount of domestic currency by the sell rate. Conversely, to calculate the amount of domestic currency you would need to exchange for a specific amount of foreign currency, you would multiply the amount of foreign currency by the buy rate. Section 7. Demystifying cross-exchange rates. A cross-exchange rate is the exchange rate between two currencies that are not the official currencies of the country in which the exchange rate quote is given. For example, if you are in the United States and want to know the exchange rate between the euro and the Japanese yen, this would be considered a cross-exchange rate. To calculate a cross-exchange rate, you would need the exchange rates for both currencies against a third currency, usually the US dollar. For instance, if the EUR USD exchange rate is 1.10 and the USD JPY exchange rate is 105, then the EUR JPY cross-exchange rate would be 115.50. Section 8. The foreign exchange market, an overview. The foreign exchange market, also known as the Forex market or FX market, is a global marketplace where currencies are traded. It is the largest and most liquid financial market in the world, with trillions of dollars changing hands every day. The Forex market operates 24 hours a day, 5 days a week across major financial centers, including London, New York, Tokyo, and Sydney. This allows for continuous trading as different time zones come online and offline. Section 9. Operations and activities in the Forex market. Unlike traditional stock exchanges, the Forex market is decentralized, meaning that there is no central location where trading takes place. Instead, trading is conducted electronically over the counter, or OTC, through a network of banks, financial institutions, and individual traders. The primary purpose of the Forex market is to facilitate the exchange of currencies, allowing businesses to conduct international trade and investment activities. However, the market is also used by speculators who aim to profit from fluctuations in exchange rates. Section 10. Spot versus forward trades. Understanding the difference. In the Forex market, there are two main types of trades: spot trades and forward trades. A spot trade is a contract for the immediate exchange of currencies at the current market price, known as the spot rate. Spot trades are typically settled within 2 business days. A forward trade, on the other hand, is a contract to exchange currencies at a specified future date and at a predetermined exchange rate, known as the forward rate. Forward trades are used by businesses to hedge against potential exchange rate fluctuations in the future. Section 11. Foreign direct investment benefits and risks. Foreign direct investment, or FDI, refers to an investment made by a company or individual living in one country and investing in a company or asset in another country. FDI is a form of long-term investment where the investor seeks to gain control or influence over the foreign entity. FDI plays a crucial role in fostering economic growth and development, particularly in emerging markets. When foreign companies invest in a country, they often bring in new technologies, create jobs, and contribute to the overall productivity of the economy. However, FDI also carries certain risks, such as political instability, economic downturns, and regulatory changes in the host country, which can negatively impact the profitability and sustainability of the investment. Section 12. Conclusion: the significance of international finance. In conclusion, international finance plays a pivotal role in our interconnected world, shaping global trade, investment flows, and economic growth. Understanding key concepts such as exchange rates, foreign investment, and the workings of the foreign exchange market is essential for businesses, investors, and policymakers alike. As globalization continues to accelerate, the importance of international finance will only continue to grow. By grasping the fundamentals outlined in this essay, readers can gain a deeper appreciation for the complexities and opportunities presented by the world of international finance. As we navigate an increasingly globalized economy, a solid understanding of these concepts will prove invaluable.